All right, Dustin TenBroeck here, back with Dave Chenet at the Presidio Perspective. We have some principles for investing for you. If you want to be profitable as a long-term investor, there's some principles that Dave and I want to talk about today. So glad you're with us. Let's get it going. All right, Dave. Good to see you again, sir.
You too.
Nice. So, look, last year, we've said it before, it was a tough year. We want to put it behind us, but we always kind of want to take pause during these times. It was a pretty rough year for a lot of people. Right? They saw their accounts decline pretty significantly. It didn't really matter where you were unless you were in cash, which was the worst place to be for about the 15 years before last year.
And the first extended period in a long time that investors really saw those losses, right? We saw pretty significant losses during the COVID crisis, but that lasted a quarter, and 2020 finished the year in positive territory.
Yeah.
So this was the first year since 08, 09 where investors really saw those negative numbers on their annual statements,
Right.
which is always hard.
Yeah. No kidding. So, and then we've come off, so far year to date, some hope spring eternal, they say, right? I mean, maybe we're out of the woods, but things are higher, and some of the stuff that had just gotten completely whacked last year is starting to show some signs of life, especially if you're looking at the fintech arena and Web3 and, those tech companies that got whacked and you thought there was nothing left, right?
Funny to see those swings in sentiment, isn't it? You see investors go from as pessimistic as you can possibly be to things start to turn around, and you see things like some of the biggest laggards from last year, the non-profitable tech stocks. Hey, you know what? They're getting bids again. You see ARK up strong. You see tech stocks up strong. It's the short-term emotional trade-off.
Well, I hate to, give away part of the secret, but what you're talking about is one of your core principles in investing profitably over the long run, which is that price matters. Essentially knowing what you pay for something and buying at a good price is a big part of being profitable, right? So It doesn't matter how far you've gone up, and it doesn't matter how far you've declined. What matters is what is the price for what I'm paying for, right? What am I paying for this investment?
And interestingly, the longer term that you look, the more price matters. Price is a difficult determinant of weekly, monthly, quarterly returns, but look at 1 year, 3 year, 5 year returns. And the biggest component of that, the biggest contribution, the determinant is the price that you pay today to own that asset.
Yeah. So a lot of the principles kind of center around that. So, when you look at these, like coming off of a bad year, I think you share this study, it's something that's not lost on us. There's an institution, Dalbar, right, that kind of has all of the financial data for fund flows, right? You can explain it better than I can, but
Love this study. So interesting to me. As you mentioned, Dalbar looks at retail investor mutual fund flows.
Yeah.
So what a retail investor captures in terms of return based on what the underlying asset class return is. So if I do the exact wrong thing at the exact wrong time, I buy a mutual fund when it's relatively high and sell it when it's relatively low.
Right.
I've missed out on all of the return of that mutual fund.
Yeah. Well, you lost money.
So what the study found is that over the last 30 years, investors have captured roughly 2/3 of the return of the underlying funds that they invest in.
Right.
So they've left about 1/3 of the overall returns on the table.
Yeah.
By doing the wrong thing at the wrong time.
Yeah. This study's been going on for a long time. I remember, I don't know if I'm going to have all the data right. I think I got it close though. So the Magellan Fund, right? Peter Lynch, Wasn't this kind of where like Fidelity had it, because he managed money? The Magellan Fund was at Fidelity, right?
Correct.
And they've always been kind of pioneers in some of this technology, and he ran it in the 70s and 80s. And I think he averaged just under a 30% annual rate of return.
It's amazing.
29.2 over a 13-year period. I mean, just crushed the market. I mean, with his stock picking strategy. So it's like what a successful stock picker can do over time. Over time, though, periods of time, Peter Lynch greatly lagged the benchmark. It's not like it was every day, every pick, and investing for like, oh, what worked this quarter or even this year or even for consecutive years. But point to point over 13, he averages 29% rate of return, crushed the benchmark. Had you given him $100,000 at the beginning, he would have given you about $3 million at the end.
But would have been
$100,000. It was $2.8 million at the end. Okay, after a 13-year, that's pretty profitable. Yes, I think I know what you're saying. It's a pretty painful ride.
If you had lived through it, the temptation is to, if it underperforms the market, to get out of it, to do the wrong thing at the wrong time.
So, are you familiar with this study?
Dalbar?
No, the one I'm talking about on Magellan Fund.
No.
All right, good. So, 29% annualized return. Okay. You think of that Dalbar, what do you think the average investor made as an annual return?
I'd say half of that. Let's call it 15%.
Okay. The average investor lost money.
Wow.
And one of the greatest stock runs ever, the average investor in the Magellan Fund lost money. They bought after a great, consecutive run, and then after it did not work out, they sold. And so you can just see that play out time and time again with the way that people invest their money.
We often joke with investors, close your eyes and look back 5 years in the future, 10 years in the future, 15 years in the future, and you'll be pleased with what you see.
Yeah.
Look at your account statements every day, and it's harder.
Yeah, it's a lot harder. So there's a couple things you have to think about with this. There's so many things actually, which we'll get to some of our principles. But what you're kind of talking about too is, okay, if you're going to look at it all the time, what is your tolerance for risk? Know how volatile something can be in, and are you willing to withstand that type of ride? Look under the hood, all that kind of stuff. But I mean, essentially what we're saying is, if you experience that, you likely experience this phenomenon that we have in our financial DNA. It's our genetic defect that causes us to buy high and sell low. And that's what we don't want to do. If you want to be profitable as a long-term investor, then you need to do the opposite. You need to buy at a lower price than where you sell and sell at a higher price. So let's kind of dig into it, right? Let's talk about some of these principles because I think it helps really break it down for people. So the first one I think is a really big part of it, something that we talk about, and it's just math part of the class, but it's knowing your time horizon and your target outcomes. Dig into that one for me a little bit.
I like to think of this as it's not only important to know what you own, it's important to know why you own it.
Mm-hmm.
So an investment that might be a great investment for a 10-year time horizon might be a terrible investment if I need to tap into that cash 6 months from now, a year from now, 5 years from now. To your point with Magellan, you've got to be comfortable with being uncomfortable. You've got to be comfortable with being wrong, to seeing those short-term losses, to recognizing that volatility in order to earn that longer-term return. So our first key tenet is take volatility where you can afford to take volatility. I think we are digging into some of the statistics on the rolling returns on the S&P 500.
Yeah.
Let's dig into that a little bit if we can.
Okay, let's do it.
So looking over every 1 year annual period over the last, call it 80 years since World War II, the S&P 500 has averaged about 9% a year. The number of years that were positive, it's about 3/4. So about 75% of the time you're up in a given year. About 25% of the time you're down in a given year. the median loss, so the years in which you were down, that 25% of years, the median loss was 11%. Now, we're looking at annual numbers, right? We're just snapshot on 12/31.
Yeah, like I think that median. Okay, so that's the median, not the mean.
That's the median.
Okay. Yeah. So I mean, there's so many outliers, right? You have, 37% decline in '08, or what was it, 22% last year.
And doesn't capture the true decline, right? The market declined between '08 and March of '09,
right,
almost 50%.
Right, more
than
than 50.
But '08 was down 30%, and '09 finished positive.
Yeah, and then you have years like 2018, which is negative, but down 1.5% or something.
Exactly.
Yeah. Okay. But so interesting, I think this is really important, right? Because if you have a 25% chance of losing money over a 1 year period, of course, that's why people don't put their money that they need, next year into the stock market.
Exactly.
Okay. So then we go out a little further on the time horizon. So you look at a 7 year. How does the number change over 7 years?
So going out 7 years, your percent of periods in which you made money goes from, remember, 75% over 1 year periods to 91% over 7 year periods.
Yeah, again, and this is buying if you replicated the S&P 500 index, right, which you can't exactly do, but financial products today do it pretty well. Mm-hmm. So you buy that index, and if you did that, you made money 91%, 9 out of 10 times.
Not only 91%, but the median loss in periods where you lost money, rolling 7 year periods where you lost money, instead of being negative 11% over 1 year periods, we're talking about negative 2% over rolling 7 year periods.
Not so bad.
So the scope
like
of that decline is
on average, it's not even that bad.
Right.
Okay, so 91% of the time I make money, and when I lose, I'm not really losing.
Right.
Right. I'm just not. Okay, so my tolerance for risk, over a 7 year time horizon, many people say that's a long enough time to be in a market cycle, certainly. To have targeted outcome. What's the median return over 7 year periods over that time?
Median return 11%.
So my median got better, my win rate got better, and my loss rate got better, or my magnitude of my loss got better. So time just is so critical. We talk about it all the time. It's the number one ingredient to investment selection is your time horizon. And how do you figure that out? It's all the math that you have to do to figure out what are you going to do with the money and when. When we talk about investing, it can't just be this infinite time horizon I'm never going to touch, right? Because otherwise you'd never be concerned about your investments. So you're concerned about your investments psychologically, emotionally, for some reason, and it's best to get that out, right? Because you have a thought of how you're going to use this money, or it's irrational, right? Either way, the math kind of helps you dig through that, kind of discover some of these things, gets rid of them.
And that's the approach that some of the smartest investors in the world take, right? If you look at sovereign wealth funds, pension funds, endowments.
Clients of Presidio Capital.
Clients of Presidio, exactly. How they determine that asset class allocation.
Yeah.
They understand what their liabilities are.
Right.
And they understand the timing of those liabilities. And then, and only then, do they build an investment strategy specific to those liabilities.
Yeah.
So I think what we've done, is to apply those same institutional concepts to retirement.
Yep.
Understanding those cash flow liabilities, the timing of those liabilities, and structuring an investment solution based around those specific needs.
Yeah. Or any investing outcome, right? Retirement's the big one, right? Financial independence, when you're actually using the money that you've saved, right? But same thing, you apply the same concept to, your debt pay down, or your, saving for college, or whatever it might be, right? Or if you've lost your job and you need to live off the savings for a little while, and how's that going to work out? So yeah, that time horizon's all going to fluctuate a little bit too. And that target outcome of what you're trying to achieve.
Yeah, exactly. And
then we cite a lot of time the 15-year, right? Since World War II, 100% of the time positive, the median return. So you haven't lost, and what's the median return on that?
Median return, 15 years, just over 12%.
So buying the index, letting it roll for 15 years, the median was just over a 12% annualized rate of return. So each year making 12%. Yeah. So if you were like, I mean, again, that's kind of what you were saying. If you were able to like take a 15-year nap and wake up or put a blindfold on, whatever it is, not look at your account, and see it 15 years later, you would probably be pretty pleased with that outcome. So, if I'm retiring and say I got $2 million saved for retirement, and I put so let's use my math simple. Say I have $1.5 million. Okay, so I'm going to start with a $1.5 million retirement account, and I just want to put 500 of that in the stock market. Okay, so $500,000, a third, not a half, not 60, not 70. Let's just say a third. So I'd make 12% over 15 years. What does that grow to be?
So if we do that math with compound growth, 12% over 15 years, starting with 500,000.
You know what? Make it 9%. So let's back out inflation, right? So let's assume 3. I get the average, 12.
Before I give you the number, do you want to guess?
1.5 million.
1.8 million.
1.8 million. So I started with 1.5. If I get the average return adjusted for inflation, kind of doing this quick math, right? You end up you're pretty happy.
Started with 500,000.
Yeah.
Right, the 500 that you allocated to equities.
Yeah, I spent $1 million.
Yep.
So anyway, this is how time horizons become so important to investing. And gosh, would I feel differently about that money that I had invested in something that has great volatility and what I need as far as a rate of return and how much risk I'm willing to take with it and so forth, right? Yeah, and I also think about how time horizon just applies, these financial concepts, because we're just quoting the stock market, but the U.S. stock market. This applies to a lot of different asset classes, right? How does real estate perform over time? How does fixed income bonds perform over time? What is their average loss rate over 7 years? I think it's 0. What's their average annual rate of return? Pretty consistent. There's not a whole lot of variability. So how does that play in? It's such a big part of investing today, right? And it's going to dominate the 2023 Presidio Perspective, I'm pretty sure. Right?
I think so.
It's just going to be the fixed income year. But it's good to have these kind of step back periods of time talking about principles of investing before getting into those nitty gritty.
So just to put a bow on that point, if we can, the only way that you don't earn that return, right, if the future looks anything like the history, the only way you don't earn that return is to let emotion drive your investment decisions and sell after the market goes down and buy more when the market goes up.
Right.
So I kind of see that as the cost of earning those returns.
Yeah. And I talked to a client earlier today whose, husband still wants to put an extra $2,000 a month of extra principal pay down on their 2.5% mortgage. Currently coming out of a money market that pays 4.6%, by the way. So even there, it doesn't stand any reason or logic, right, of that time horizon and that target outcome. What are you trying to do with this money?
Exactly.
Yeah. I'm going to take it from something that's liquid and it earns me 4.5. I'm going to put it in something that's illiquid and earns me 2.5.
Or even worse, take out of this long-term equity portfolio that we talked about that over a 15-year time horizon could earn between 9 and 12%, and use that to pay down a 2.5% liability.
Right. Yeah, that'd be a lot worse. So knowing your time horizon, target outcome. Number 2 is you say be valuation sensitive, which is essentially be aware or sensitive to the price that you're paying for what you're investing in, right?
Exactly. We alluded to it earlier in the conversation, but one of the biggest determinants of long-term returns is the price that you pay today to buy that asset.
Yeah. And I mean, this is something that people don't really look at, especially in bull markets, right? So when we're sitting there in a bull market and everything's going up, and this is what investors, we all have this, is we just look at this past performance, and although every single disclaimer says past performance is no indication of future results, it's what we have to go on. And so people just say, wow, this is going up, I want to buy this thing that's going up, and this is going down, I want to sell this thing that's going down. And that's all the real logic that people can really apply to something, is that this must be a trend that's ongoing forever.
I feel bad that I missed out on that positive performance in the past, so I want to make up for that by buying the thing that I wish that I had owned before.
Yeah.
But the problem is, more often than not, you end up selling the thing that you'll actually need going forward.
Well, that's a good point. You could do that. Yeah. So apply this a little bit more to how I'd make investment decisions in my portfolio. So, like, if I look at, give me some applications to where, like, prices mattered, so listeners can kind of better understand of what that means to them and their investment decisions.
So one of the most stark examples of this I can think of is the 5-year period before and after the dot-com crisis of 2000.
Okay.
Right? If we think about what tech stocks did, dot-com stocks did leading up to that market peak.
Yep.
Tech had outperformed financials by about 80% in the preceding 5 years.
Yeah.
So you would have not been very happy if you were an investor in financials.
Sure.
And had been underweight tech over that period.
Yep.
But look at the 5 years.
Internet and, this birth of unprofitable tech just taken off. Yeah, you made a lot of money.
And the narrative of the new economy, valuations don't matter. The internet will continue to drive prices of these stocks through the roof.
I thought you said 2000, or are you talking about 2021? It's hard to decipher the difference here.
We'll get there.
It is interesting though when people talk about the new normal. They always do on the ups and the downs. Oh, it's different this time. Mm-hmm. But anyway, keep going.
So let's look at the 5 years after that tech bubble popped.
So 5 years, tech beats financials by 80%.
Yep.
Okay. Then the next 5 years, 2000, 2005, I'm assuming.
Financials beat tech by 100%.
Right.
In fact, if you had put money in tech stocks at the top of the market in March of 2000.
This is the NASDAQ?
The NASDAQ.
Okay.
You wouldn't have made $1 on that investment for 17 years. You wouldn't have seen a positive return until 2017.
Yeah. Wow.
That's a long time to be underwater.
Yeah. It's interesting, too, sadly, because I know the statistics, right? I mean, the NASDAQ declined, was it 89% or 83%?
Almost 90%.
Almost 90%. So that, I mean, gosh, a lot of similarities happen with funds, right? Let's talk about some of those ARK funds, but then individual names, right? And just last year, from 2021 to March of 21 to last year, right? You saw those 90% declines. But anyway, what happens when that, how many of those investors flipped out of those NASDAQ tech companies and into financials, right? As they sold low, and now financials are the best. That's what everybody did. And I remember the phenomenon in the 90s, growing up in Silicon Valley, and I remember the headlines, I remember learning, I remember all the euphoria, and I remember the internet. And then I remember in the 2000s, it was just so real estate focused. It was just real estate will never go down. It will always go up, and everything is just lending on real estate or buying real estate or flipping real estate. And then financials are supporting all that. So if you're in the equity markets, you're there. And then what's next? So now financials are the number one performing stock from I'm betting going through the financial crisis, they were probably the worst place to be over the next 5 years.
Even longer than that, right? Looking after 08, 09, the subsequent, what are we going into 2023 now? So 13, 14 years, financials have lagged the market significantly.
Yeah. Well, and some of them aren't in existence today.
Right.
Right. That posted those numbers from 2000, 2005. So I think I get, when we talk about the application for investors today, this is where, you look at a portfolio and you have to be disciplined, and so, for instance, asset allocation is important. And so if you have, as an investor, a set asset allocation that you say, I want to perform in information technology companies that I think are going to revolutionize the planet or whatever, I think I think they're at a good price. I'm okay going in there. And what happens is during these periods of elation, when people talk about the new normal, right? It's kind of time to take pause and get a little cautious, right? Those are some good warning signs. But had you totally, what are you selling to go more into that, right? You're losing that diversification. And as this winning sector becomes a larger swath of your portfolio, and you're rewarded for making that decision. It doesn't happen like day to day, right? Investors are watching a trend that took place, and so they jump in, and then they see it go up, and they go, wow, it worked. Had I held on to the thing I sold and not done this, I would have been worse off. But we reached that apex, and it's all given back and then some.
Yep.
Well, now what do we want to do? We want to rotate back, and so it's really difficult to not have a discipline as far as your asset allocation.
The cycle of fear and greed. I think love the Benjamin Franklin quote in this context. If you fail to plan, you plan to fail.
Yeah.
I think it's building the right plan based on what you need your portfolio to do for you to meet your financial goals. And it's having the discipline to stick to that plan.
I mean, by the way, in those last few years, it was astounding how many people's portfolios I saw that were like 50% in that information technology sector. And they were right.
Yep.
And it's so hard. And then, it wasn't, it all of a sudden became not uncommon to for me to find somebody with all of their money, and I mean significant wealth, millions and millions and millions of dollars in one company. And they were right up until they weren't, right? And it's just crazy that cycle, that psychological. So it's important to have these principles. Now, it's not a call on information technology you're making. It's not a call on financials. It's a call of understand the price of something that you're paying for. And so if you want to dig in a little bit and you look at, how much does the company earn, how many times that earning, the PE ratio to give you a little sense of what you're paying for. If you want to look at some projections, I mean, how far into the future is it going to be until this company is profitable? Know how sensitive it's going to be to economic fluctuations and market cycles. And how easily just a little bit of a miss will turn it very, very wrong. A lot of things have to go right on highly priced stocks. Yep. But then what you find is these things that everybody hates because they've lost money. So just like everyone wanted to buy it, not because it was at a good price. Maybe it was a good company. But, I was using the analogy with you earlier about Starbucks. Like Starbucks proved to the world that you can go pay $5 for a cup of coffee. And a lot of people said, you're not going to be able to do that. They did it. $6-7 sometimes, depends, right? I mean, then you're buying everything else. I mean, it's astounding. But could they go to $35 for a cup of coffee? Like, probably not. Does it mean that Starbucks has bad coffee? I know there's some people that say yes, but most of the world has spoken. They like Starbucks coffee, but they're not willing to pay $35 for it, right? And so you can say this is a great company. And I think a lot of people chase some of these really big names, revolutionary companies. They think that like, oh, they're going to change the world. It's a great company. That all might be true, but do you realize the price that you're paying? You're paying $35 for a cup of coffee in the end of the day. And you can go next door to the less sexy, less notable to get, the same cup of coffee for $5 or $4 or $3, right? And oh my gosh, how many cups of coffee could you buy? You could buy 11 times the coffee at the neighbor's house than this one cup, So that's how we want to start thinking about valuations of the things that we buy in the stock market, right?
Yeah, exactly. I think it's human nature to say, hey, I like Starbucks coffee, so Starbucks must be a good investment. I like Tesla. I think Tesla makes a great car. Mm-hmm. Don't necessarily think that the valuation that Tesla stock was trading at its peak made sense for the underlying value of what they brought to the market.
Yeah.
So hard to differentiate between the product that a company creates versus whether you want to be the owner of that company, whether you want to buy shares of that company at a given valuation.
Yeah. I mean, you want to be an owner, but there's got to be the right price.
Right.
You just have to make the deal at the right price. And so that's just a lot. We as investors just have a really hard time making It doesn't make sense. If something's going up and I buy it and it goes up again, then I was right. So
Yep.
And that Tesla's a good one. You could have been making that call for years and looked very, very foolish. And many people lost a lot of money shorting Tesla stock. More people lost money betting against Tesla, right, than lost money investing in Tesla. That's not a proven study. I'm just hypothesizing, but I bet you I'm right. Anyway, okay. So price matters. I like it. And so, buy at a good price, know the price that you're paying, and be disciplined with respect to your asset allocation. Right, so don't just come chasing the shiny object. Okay to tilt if you kind of want to play that game, but just know what you're playing. You're taking from somewhere in your portfolio.
Correct.
Concentrating risk somewhere. Your risk is increasing. Your reward is increasing. Your risk is increasing. Okay, so that's okay. All right, what's number 3? Understand that markets have cycles.
Yep.
So explain that a little bit.
So I think if we think about the traditional market cycle, you see markets go through these 5, 6, 7, 8-year periods of pretty steady rises.
Yeah.
And then it comes to a point where euphoria is high, where valuations are high, where investors are overextended, where corporations are overextended. Something happens to change the inflection point, and markets go down substantially. So as an investor, you need to be comfortable understanding where we are in that market cycle and knowing that nobody has the ability to perfectly time those inflection points. To understand the goal isn't to perfectly time the market. The goal is to understand the risk-return trade-off in a given market. And if we're in, call it the 7th inning of a 9-inning bull market, maybe it's time to take a few chips off the table.
Yeah.
Conversely, what do we see during recessions? So markets typically bottom not during the worst part of the recession, but as we start to enter into that recession. So when the economic pain is the worst, you actually see markets on the upswing from there.
Right.
So if you as an investor can change how you think about markets, to change the risk profile that you take, and be willing to accept potentially lower returns when the market continues to do nothing but go straight up, for the trade-off that as the market turns around, you'll be a little bit better protected and able to then start accumulating a few more risks, adding to your equity positions at more attractive prices.
Again, these 3 principles are so great, Dave, because they all are very key in just helping investors not buy high and sell low. I mean, this is it, right? I mean, if you can set your time horizon, know your target outcome, you're going to make much better discerning decisions about your investment selection, asset allocation, risk, all that, liquidity. If you look at the price that you're going to pay for something, you're getting 50% of it done, right? You got to buy low, sell high. And so buying at a good price is just puts you so far ahead of the game versus needing a bunch of stuff to work out. If you buy at the right price, you don't really even need everything to work out to be profitable, right? Holding through a market cycle, you certainly wouldn't. And then market cycles is just, again, if you just think of that wave, you take an S and you drop it on its side, and that's a market cycle. It just goes through that wave. And look, there's a lot of debate. It's a kind of a black magic, dark art kind of phenomenon of determining where we are in the market cycle. But we have a data point in history that we can look, right? And so I always just for myself look back a year ago and say, are things better? And if they are, then I know that where I've been is on this incline, right? And how steep or how significant has that change been over this time? If I look back a year ago and say it's about the same, right? Markets and economic data and life, maybe it's a little flattening out. If you look back a year ago and say, oh, things were better, well, you kind of have an idea of where you are in that market cycle. And if that's something you're saying, you're like, okay, I'm on this decline. But then to understand, that you have at least a sense of where you are, right? And so you can look back and go, oh, that was the top. Okay, well, where are we approaching? So, okay, I should embrace for some weakening because that's what's happening. If I look back a year ago, it was worse. Like, are investors bracing for this? It's like we're shocked that the market goes down sometimes. We're shocked that, the economies don't just grow consistently, robustly. Like, this has never happened. It's market cycles. Mm-hmm. And if we know that, it's not saying that, oh, you need to predict the market cycle. Now, that would help, and maybe hire some professionals to help you. I'm biased, of course. But, even then, you can only predict so much. You kind of have to prepare for multiple outcomes, known knowns, unknown knowns, and unknown unknowns. I mean, it's challenging, right? But you won't be so surprised, kind of like, oh, things got worse and the news got worse. And kind of I'm like, oh, this is like when the markets are going to really perform, or this is when I want to start maybe increasing my beta in my portfolio, right? This is when I want to be taking more risk in the portfolio. And knowing that now, ahead of time, right, is really going to give you that grit and that resolve, that because otherwise, if you used our brain that says, well, things went down, they're going to keep going down, I'm going to get out.
Yep.
That's what your brain's going to tell you.
Yep.
Just like when things keep going up, you're going, oh, I'm buying that, putting all my money in that. That thing keeps going up, that's what I'm buying. Don't look at it that way.
Yep.
Right? Look at your time horizon, target outcome. You got to be disciplined with your asset allocation. Worry about the price and where it matters, and have some sense that market cycles evolve and where you are. Maybe just to give you a little lens into the future. And you look far enough out, market cycle is going to go like this, and the horizon's way up at the top, right?
Know what you own and why you own it.
Yeah.
Knowing that you're owning that volatile asset in a long-term investment bucket or portfolio gives you confidence to hang on, to not make the mistake that runs your portfolio off its course.
Yeah, absolutely. All right, Dave, these are great, man. Thank you for bringing this wisdom to the Presidio Perspective.
Thank you.
Yeah, looking forward to getting back with you next couple weeks. Everybody at home, thanks for tuning in. We'll see you next time.